Well, very good. Looks like we're at the top of the hour here, so
Okay.
we'll go ahead and kick it off. I'd like to welcome everyone listening in or watching and joining us. Scott Oeth, Cahill Financial Advisors, principal here, specializing in wealth management, asset management, financial planning, and have really been enjoying running this series of wealth strategy sessions where we talk about different specific advanced planning topics and often bringing in true experts to help us. Well, we have a very, I'd say, pretty deep and very broad view of the landscape and being able to help people sift through and look at different strategies. We definitely know who to call on, importantly, for the real deep, specific knowledge and implementation. And that brings us to our special guest today, Jason Bolstad with Tax Sheltered Consultants, also known as TSC. I think you guys usually go by the TSC name at this point.
Indeed.
But Jason is, you've been there almost 20 years now. Is that right?
Yes, I have.
Yeah, I think I've probably known you for about 15 or so.
Yep.
Our offices used to be across a parking lot. We'd bump into each other every once in a while. And
Till we moved.
whenever I have a tough retirement plan question, I know who to call. Jason's the guy. And I'll say that we, as a disclaimer, we're completely separate. There's no financial relationship. I think, we talk to each other and share ideas and have had some mutual business connections in the past, but there's no financial arrangement between the two of us. And thoughts and opinions expressed are each our own. And also the other big disclaimer is this is a general information session. We're sharing ideas here. Nothing here should be interpreted as specific advice for anyone listening in. Seek your own counsel. Give either of us a call at the office when you talk about how it applies to your situation. But, Jason, I think, in addition to truly being an expert in this field and in retirement plans, retirement plan design, one of the things I just want to say thank you. I always appreciate you are really timely and spot on. Every time I have a question, you've been great about getting back to me very quickly and efficiently. And you've got just a nice style of, I know this is going to be a great call here because you've got a really nice style of explaining things in a
Thank you.
unjumbled
You're
manner. So,
Yeah.
Well, and one of the things we're going to talk about here, this is one of my favorite strategies. You look at sort of the array of wealth accumulation techniques, tax shelter techniques. For some people, asset protection is a concern. What we're talking about today checks the box on all of these. And what I love about it is there is nothing questionable. There is no gray area here whatsoever. We're talking about cash balance pension plans is defined in the tax code. It's very straightforward. There is some complexity, certainly in the design and in the maintenance. There's a bit of cost to them, but when you look at the potential advantages for just tremendous tax shelter and rapid retirement plan catch up, this is really one of the favorite techniques that can be employed. I think it's important because a lot of the people that this applies to, we're talking about this primarily from the perspective of working with business owners, either solo, highly compensated consultants, professionals, business owners, or small, mid-sized firms up to bigger sized companies. But oftentimes, I think there might be a negative connotation. Say, tax shelter allows you to put a lot of money away. Is that a good thing? Well, I think what's missed and what we see is oftentimes a lot of these people, they bled into that business for years and years and years and decades, building it up, putting every extra penny they had into making it go and just surviving during the lean years. And so, they may reach a point in time in their 40s or 50s or maybe even later where all of a sudden the success has come and the revenue is there and the earnings are there, but they look around and say, yikes, what am I going to do about retirement? I can't do this forever. But I was working on my advanced training or designations or degrees and building my clientele and my business over a long period of time. How do I get caught up? And this is really one of those strategies that can let you do it. I think it's a really great thing that it's there for those purposes. So, But maybe in that context, there are large corporations that have put in cash balance pension plans, and that's a great thing too. So there may be people who catch this either audio and a podcast later, or I encourage you to check out video. We'll post this on YouTube, because I know Jason's got some graphics and charts and things like that he'll share. A lot of the same concepts apply. Just be more understanding how this benefits you in terms of what the company is putting in on your behalf. But I think we'll just kind of say that we're coming at this primarily from the perspective of the business owner. Right. So maybe to set the stage a bit, and up front, most people are familiar with the concept of a 401k, named after tax code, allowance that allows for employees to defer compensation into a tax sheltered retirement plan. There's a couple different levers employers can pull to add to contributions that lets people deduct income during their working years, invest in that plan, build up a benefit, draw it out, and just a great tool. This is where a lot of wealth is created. I mean, when I look across my client base over the years, having worked with hundreds of clients, this is usually the number one tool. It's the 401k plan. But when you get into other types of plans, and there's a variety, people aren't as familiar with them, okay? And they're more familiar with the concept of, there's kind of chocolate and vanilla, right? There's defined contribution plans, which is what most people are familiar with now. And then there's defined benefit retirement plans. And you have to kind of go back to grandpa's era, where he worked for a company for 50 years and got the gold watch and then collected a check on the first of the month coming from the pension plan. So maybe can you help us set the stage in terms of what we're talking about here in these different types of plans, and 401k versus cash balance plan?
Yeah, absolutely. So as you say, the 401k plan is what everybody knows today. As a matter of fact, you even see a lot of simple IRA plans in my observation lately. Those are going away in favor of 401k because it is so well known. Business owners are tending toward that because their potential employees know what a 401k plan is. They don't really know what a simple is. But both of those, in the parlance they use, defined contribution plans. So the limits in these types of plans are based on how much can you get into the plan today. The 401k limit next year, $22,500 in salary deferrals, plus an additional $44,500 on top of that, $43,500 on top of that. Gets to be quite a bit, but that's the limit in the 401k plan. Whereas with the defined benefit style of plan, cash balance plans being one of those, the limit is not defined by how much you can get in today. It's defined by how much can you take out in retirement. And with that being the limit, you now need to get an actuary involved, because they're going to figure out, based on what you can take out in retirement, based on your time horizon to retirement, based on all of these factors, how much can a given person put into a cash balance plan. And it's that to your point, Scott, the business owners that have been putting everything back into their business over time, and now they're waking up and they're 55 years old, as an example, and they're behind. Well, the great thing about the defined benefit plan is that, or the cash balance, you're now starting at age 55. You are about 10 years from that retirement horizon. And because of that fact, your today's cost of funding your retirement for the rest of your life at age 65, let's say, is quite high, because you're so close to that benchmark. And so that's what gets to be attractive for those business owners that perhaps feel like they're behind. The defined benefit plan works in their favor because it's not limited by how much I can get in today, because they didn't put in when they were 25, 35, right, because they were putting it into the business.
Right. Yeah, it's very interesting. It turns it from this is how much you can put in the plan each year, that defined contribution, to a math problem. This is the target according to IRS limits. This is what we're aiming for. How do we work backwards into getting that funding number? It's kind of like how we think. working with clients about retirement planning in general. We aim, okay, you'd like to retire at age 65, you want to send your kids to school, you want to be able to travel, you want to, what is that X, what's that magic number we're aiming for, and how do we work back into that? And that's kind of that's the methodology or the thoughts on the defined benefit type plan and why it can allow for such large contributions. I did want to go back to maybe just one or two things that you had said that I thought were interesting. Sounds like you're seeing, I feel like we're certainly hearing about this. It's been tough to hire over the last year, 2 years, very tough to attract and retain talent. And it sounds like you're seeing a trend towards enhancing plans, business owners to have the 401k plan in there because it's known, it's recognized, it's easy for employees to understand what it is, even if maybe there's a simple plan, with savings incentive match plan for employees, or the SEP, simplified employee pension plan. Even if those are in place and providing a good benefit, they're not as well understood as that 401k plan. And it sounds like you're also just seeing maybe just a general altruistic move towards wanting to be able to help provide a secure retirement for employees.
Both, right? Yes. And as great evidence of that, 10 years ago in the 401k world, the vast majority of the plans we were setting up at the time would have a 1 year wait for the employee to become eligible. That is very rare in the last 2 years. All of the plans are moving toward that waiting period being much shorter. Matter of fact, last year, 2/3 or more of the plans that I set up new had a 3-month wait to get into the plan. And that seems like a really minor item, and it sort of is, but the fact that it's happening is a nod to the fact that business owners are trying to find employees, make that plan look as absolutely attractive to a potential hire as possible. And that's the same goes for simple versus 401k, because of the recognizability of a potential hire of the 401k plan. Nobody across the table from you that you're trying to get to come to work for you, nobody is ever going to say, hey, do you have a simple IRA plan at your company? That's just not what happens. It's, do you have a 401k plan? And the follow-up question might be, what's the match? And those contributions as well are increasing over the past 5, especially the past 3 years. Again, more, even if it isn't altruistic, it is done to be more generous and look more generous, to be more attractive, to find more people.
Right. Yeah, kind of related to that, we're seeing more questions, having more conversations, not only about the plan design or that plan structure, moving from a simple to a 401k plan. What's the match? Very interesting what you're saying about cutting down the wait time, but the types of investments in the plan. We're having more conversations. Certain companies, certain industries in particular, the employees are very interested. We see again and again statistics about interest in ESG investing and investing with a cause, and those types of things, and looking at what is the investment menu. And I think our primary concern is helping make sure there's a good selection there, so people can make good choices to actually build towards their retirement consistently, and they understand those and understand how they work and how to use them. But there certainly is growing interest in being able to have those other types of investments in the plan as well.
Yep. Yes. All things moving toward employee-centric items, whether it be the amount of the contribution or where it can be invested. Absolutely, I agree.
Yeah. So something you touched on, and I think for getting into the bulk of this session, we're kind of stair stepping over to cash balance, but really that profit sharing formula, maybe just to spend a minute or two on that, because we find working with business owners, that is often a big step that they can take to really enhance their savings for retirement, their tax shelter, and there's some because people go, well, profit sharing, what is that going to cost me? I'd like to help my employees, but how much do I need to contribute? And there's some newer methodologies in terms of calculating that formula that can allow for a really significant contribution, say for an older business owner. Anything you can share with us on that?
Absolutely. So in the 401k plan of today, you've got the ability for the business owners and the employees to make salary deferrals. You know, that's that $22,500 limit, next year's numbers, or 30,000 if you happen to be 50 or over, like some of us are. That's the 401k piece. Over and above that, next year's limit is $64,000. $66,000. It's new enough that I don't have it committed to memory yet. $66,000 would be the total amount that one could get into this defined contribution plan, the 401k plan. Well, the trick tends to be, how can you get to that number for the business owner? Because as you say, non-discrimination testing, which is the bulk of the reason that we as a third-party administrator exist, to make sure that businesses are not stepping on any regulatory landmines. So in other words, making sure you're not running afoul of these tests, including non-discrimination testing. Well, so how do you get a $43,500 profit sharing contribution for an owner while keeping contributions to employees at a more reasonable number? And if, as you said, Scott, if the business owner is older, then this concept is one that works. It's called cross-testing, new comparability. And let's just oversimplify and say that we've got a dentist that's 55 years old and one employee that's 30, okay? Just to illustrate this concept. Well, the dentist being 10 years from retirement, the employee 35 years from the same age. If the dentist were to give the employee a 5% of pay profit sharing contribution, that buys a lot of retirement over 35 years.
Right.
In fact, because the dentist is only 10 years from retirement, the dentist would need a 30% contribution to buy the same amount of retirement. It is by, it's simple in concept. And it's surprising to many that we can use this concept when it comes to the 401k plan, but you really are crossing, which is why it's called cross-testing, crossing the idea of the defined benefit plan. We're calculating what the benefits are at retirement for these two people at different ages. And we're proving that 30% for the dentist isn't buying any more retirement than 5% for that 30-year-old. That's the concept of cross-testing. Now, add more employees, as long as you still have enough of those employees that are younger than the owners/owners, that concept can still work. In fact, we see a lot of times that a 5%, which is a magic number in our world, doesn't matter why, 5% total contribution for the employees can buy the owners the ability to max out at that 66,000 number very often by implementing this idea of cross-testing, this concept, testing methodology, call it.
And I think what we see when we talk about this often is, okay, I'd like to do something. I'd like to put an additional benefit in to help employees. Business owner or owners are very interested in the idea of, putting the boost on their savings and more tax shelter, because every extra dollar that goes in the plan, just to clarify, is not a dollar that's showing up in their personal income tax return and having taxes paid in it in that year. But you get into this kind of trap and say, well, geez, 5% contribution for all my employees, that's starting to sound like a lot. But we can pretty quickly look at the numbers and say, but owner, this is your contribution. And if your tax savings dollars, real tax savings in that year, outweigh the dollars of contribution for the employees, it's a win-win all around. You're making a very meaningful contribution for employees, helping them out in their path to retirement security, and saving on your taxes, right?
And you, back to our earlier conversation, you've got a 5% contribution. That second question that employee asks, do you have a 401k plan? Second question, what's the match? Well, you're going to be able to say, well, better than a match,
Right.
we've decided that we're going to give you 5% of pay, whether you like it or not.
Right.
Because we understand as a business that sometimes life gets in the way for you as an
Mhm.
employee, and you might have to stop putting your own money in for a period of time. We're going to still give that 5%. So it's not a match. We call it non-elective contribution. Call
Yeah.
it a gift, call it profit sharing, call it what you will. You're getting it whether you like it or not as an employee. So that checks the box for the potential hire.
So love it. 401k is a great tool. Most people think about that salary deferral,
Mhm.
and that can build up a large balance. The match comes to mind. What does the employer match? But there's this third lever. So employers can make a match. They can also make a profit sharing contribution, and that can be very meaningful for employees, and it can be really substantial for the business owner. So that's a great tool. Now, let's say you've got, say, business owner, they've worked hard, the wind has hit their sails after years of building the business, and they're looking for rapid accumulation of retirement savings or just general wealth accumulation. It doesn't have to be specifically retirement dollars. It's money that's being put away for later, and large tax shelter. The next thing that we'd probably look at is the cash balance plan. And maybe I think you've got some examples or can help us
Yeah.
kind of get some numbers in terms of what that actually means and where that could take a business owner.
Yep. Let's look at my dentist example, but with some more employees. So this is an example we use a lot, and it happens to be that same 55-year-old dentist that I had mentioned.
There's a lot of them.
And there are a lot, and this narrative here is how it tends to play out in their world. They have 6 other employees. The dentist has been saving maybe 60,000 a year in the 401k plan, but it's not enough because it's most of the time has been spent building the business over time, and paying off loans and equipment and such, putting their kids through college. We're all
Right.
understanding that.
Do
But
they still have to pay as much for braces?
that's a great question.
We do.
It's a great question. Here you're going to see that the 55-year-old dentist has 2 hygienists that are 48 years old each, making 70,000 each on average. 2 assistants making 40,000 each, and they're 34. And then the 2 office people making 25,000 each, 24 years old. This is a 2022 example, so the 20,500 in 401k. You're going to see here, and I'm on the 401k column, I'm showing the dentist deferring maximum and the catch up. Interestingly, I'm showing that the employees are deferring in the salary deferral 0. They certainly can,
Right.
but I wanted to show this being 0 to underscore the fact that there is no match in this scenario.
Okay.
There would be a profit sharing contribution going in, and then a contribution in the cash balance plan. So in profit sharing, the dentist is getting 14,000 and change. The hygienists are getting a total of 10,500, and you see those numbers. But then the cash balance plan. These 2 plans, by the way, are working in concert from a testing standpoint. The actuary is considering both of the profit sharing contributions and the cash balance contributions together for the non-discrimination testing. What you'll see where the rubber meets the road is that the dentist is depositing annually, tax deferred, 281,000 and change, while giving is that 16, 20,000, 21,000 or so to the employees.
And maybe to pause for a moment, Jason, because we get to this point, see people, they can't quite believe it. Is that right? What do you mean? I mean, a $240,000 contribution. I mean, just in ballpark numbers, that could be saving something like, let's call it $100,000 in taxes between federal and state and
deferring. Yeah.
Yep, exactly. By deferring that into this plan. Yeah.
Yeah. It does come as a surprise to many, but as we started out with, That's what makes it great, is that for this 55-year-old that is now needing to play catch up, it's a real number.
Mhm.
It is a win-win as well, because these are generous contributions for the employees. If you think about it, that for somebody making 25,000 to be getting 2,100, it's about an 8% contribution in total, and that's all company contributions.
Everything
Uh,
coming from the company. This is none of their money. They could still defer
that's
their own
right.
salary
They
to the
they
plan. Yep.
absolutely. And
Mhm.
so that this is coming from just the company, and and that's what makes it such a win-win, because 8%, most of these people can go to their neighbors and ask what they're getting in their plan, and it's going to be a 4% match or a 3% match, something like that. The fact that they'd be getting about 8% is a win for them. But if you think about it, it's a great win for the dentist, because
Yeah.
now he's able to play catch up and get these bigger contributions.
And if we look over in your totals column there,
Mhm.
in your example, 2 hygienists, 2 assistants, 2 staff, six employees getting a total of was about $11,000 between them contributed from the company. So nice contributions towards their accumulation. But the dentist putting that extra 240,000 in there again, we're talking about saving very likely something like $100,000 in taxes. So
Yep.
contributions of $11,000 to help your employees, saving 100, give or take, thousand in taxes. Real tremendous win-win here.
Yep. And of course, the dentist is going to be paying tax on this when you take the money out of the plan
Yeah.
again in
Mhm.
retirement.
Mhm.
But um, this is being put in when they're at their highest earning years, and therefore at the highest tax bracket. And
Mhm.
so that's where it becomes a savings over time.
Mhm.
Something that often gets asked, and I'll just preempt it, is I'm noticing that under the cash balance column, the hygienists are not receiving anything. What's going on there?
Mhm.
Well, you need to benefit at least 40% of the total eligible workforce in the cash balance plan. And it just happens that hygienists would be a good break point to keep ineligible. Um, Another concept that's a bit in the weeds, but I said that these two plans are tested together for non-discrimination. The profit sharing contributions to the employees are a little bit more valuable when it comes to the non-discrimination testing. We're able to project those contributions out at 8.5% per year toward retirement. Cash balance projects out at 3 or 4. So by giving the hygienists their contributions all in profit sharing, it helps to skew the benefits more even toward the dentist.
Mhm.
And in this case, as we say here, 93% of the total outlay is staying in the account of the dentist. So
Mhm.
75%, that is the number when an actuary puts this illustration together. That 93% number is the targeted number for the actuary. How can we get that number as high as humanly possible? And
Mhm.
that doesn't sound great, but again, this is a win-win with 8% going to the employees. For them, it's great. For the
Mhm.
dentist,
Mhm.
really well.
Yeah, and your point about for the dentist taking the deduction for this contribution during high working years, high income working years. I am having done this for quite a while and looking at many long-term scenarios, both as people are accumulating and then taking money out in retirement. Even if that tax rate stays the same effectively, it's a win because they're able to put those dollars to work, let dollar for dollar of earnings work over a period of a decade, a couple decades inside the plan until they take it out. And so it lets those dollars, you truly capture the power of those dollars in earning on your balance sheet, even if they're taxed at the higher rate. I think that's in most cases a win. I might want to stop for just a second and clarify kind of different players, because you mentioned actuary. It says actuary in the bottom corner here.
Mm.
We're a financial advisor, we're an investment advisor here. We're looking at the broad gamut of things clients are facing. What are their goals? What are their hopes and dreams? What do they want to make sure doesn't happen? What are they trying to build towards? And we're trying to understand the overall tools and how we help people get there, let them know what they need to be saving to be on track. And we certainly have a working familiarity with concepts like this. but then you work for a TPA, that is your role, third-party administrator. And because this is a great technique, but it's a pretty complicated one, there's another player involved, actuary. So this is
Yeah.
not something you can just kind of noodle out on the back of the envelope yourself. Maybe can you tell us a bit about third-party administrator, actuary,
Yeah.
how they come into play in this type of proposal and plan?
Yes, absolutely. Because of the complex nature of how these worked, where we started in this conversation, that it depending the cash balance plan is defined by how much you can get out in retirement, and then you have to discount it back to today's and then project it out. All of those things, you now need to have an actuary involved in the plan. We don't have actuaries on staff here as a third party administrator. Some might, we choose not to. And as a recovering engineer myself, I think I can make the joke that, who would want to have one on staff? It's an actuary,
Who else? Yeah.
and Charlie, so Cash Balance Actuaries is the firm that we choose to work with on for actuaries. Charlie Steinges is the owner of that firm. He would appreciate the joke too, actually.
Yeah,
But
I think like I'm a finance guy, undergrad, masters, financial planning. It's not math, but there's a lot of numbers involved. There's a lot of other elements. You're an engineer by training. You're a math guy, but actuaries, I mean, they're really mathy, right?
it's a different world. Yeah, they're yeah, that
Yeah, yeah,
yeah, but they are a necessary part of this, and as such, and I know we're going to get to cost as a
right.
topic, but because of that involvement, there is a higher cost factor when it comes to a cash balance plan. Now, for this dentist, even that higher cost, if this plan costs, the cash balance plan costs an extra $4,500 a year to bolt on to his
Mhm.
existing 401k plan, you wouldn't do it unless that cost were dwarfed by the tax savings over time. So that there is higher cost, and we're very upfront about that, but it's usually it's sort of a non-factor because of the tax savings over time.
Yeah. Maybe one other professional area that's I'm going to draw the line a bit because there again, working familiarity, we're not attorneys, but many people, especially in occupations that could be deemed high risk for litigation, asset protection is an important consideration. And qualified retirement plans like cash balance retirement plan have a very high level of asset protection
Creditor
standing,
protection. Yep.
creditor protection versus say in this varies somewhat state by state. So seek your own counsel, talk to your own
Yes.
attorney if you're getting involved in this type of planning. But IRA protection limits are can vary depending on state law or saving and building up money in other areas. If you're trying to build up a real estate portfolio or just your brokerage account, it's not only the tax savings and the ability to put a lot of money in here, but in many ways, for a lot of people, it's important that they're putting money into a almost like a vault, right?
Yes. Yes. It not only do you get the tax savings, but you do get that extra protection. I would agree
Yeah,
wholeheartedly. Not much more I can say about it other than
right.
great point.
Yeah. Well, let's see. Do you have maybe some other examples
Yeah.
you can talk
So
us through?
one of the things that we have to address always when it comes to cash balance plans going to be, okay, I see this number. I as a dentist, and let's pretend it's not a dentist because dentists tend to make pretty consistent income over time. But what if a business owner is not
Mm,
making consistent income over time? There, if there are a few things that somebody might know about a cash balance plan, or their accountant might know about a cash balance plan, is that they do have a commitment. And indeed, you do need to commit to 3 to 5 years. Why doesn't the IRS just define which one it is? I don't know. But at 3 to 5 years, you have to have
uh-huh.
the plan around. And so it does need to be funded for 3 to 5 years. And so oftentimes the business owner is going to look at this number and say, oh, 240,000, that's great this year. I'm a little concerned about what that might look like if I don't have such a great year.
Right.
And that is a concern. It does still need to be funded. However, and bear with me just for a short explanation, that cash balance, $240,000, could be defined. It has to be defined in the document. And in this case, it might be the most simple way to define it is $240,000 is going to be your annual allocation to the dentist. Well, that's no flexibility. Better than that might be 24/30ths, which is 5, 6. It's 80% of pay. Let's call it. Might be your formula, something like that. So now, if you take less pay, your allocation is less. But even better, we can do a flexible formula, and I have an example of this somewhere. Here we go. So again, this is an attorney, right? Maybe a personal injury attorney, somebody that does not have very consistent. Yeah, there. Thank you. Very good. That's a great explanation. And for this attorney, the cash balance, if you look under the green, the cash balance formula is, in this case, 10% of pay, and that's like W-2 pay, 10% of W-2 pay on the first 100,000, and 100% of pay above that. So now she has a down year. Alicia takes 100,000 of pay. She considers that a down year. So you see under 401k, she's not making any 401k contributions to, which is up to it. She's not deferring anything. She chooses not to give herself a profit sharing. And by the way, Alicia has no employees. This is just her formula.
High earning solo
this example. Sure. And because we've got this formula in place in this down year, she's taking 100,000 of pay. 10% of that is $10,000. Down year, $10,000 deposit. Next year, she has a great year. She makes $1 million. She therefore takes 305. That's the compensation limit for this year. So that's all we can consider, or the actuary can consider. But she now takes 305,000. Great year. Let me defer the maximum, 27,000 in deferrals. Profit sharing limited in this case to 6% because of the existence of the cash balance plan. That's a deductibility limit. Maxing out the profit sharing at 18,300. Now that same formula that was written into the document returns an allocation for this year of 215,000. So by being very diligent about setting the formula up in this flexible way, Alicia is able to put anywhere from 0 in a really, really bad year to 260,000 in a good year, and still be funding the plan year over year. So that's how we address, one of the ways we address that permanency issue. You have to have the plan around for 3 to 5 years. Kind of a safety net, if you will, down year.
That's great. Obviously, huge consideration for business owners thinking, well, we're heading into a recession. Okay, we're all talking about that. Or I might need to plow money into the business next year because I need to hire some more people or buy some expensive equipment, or it may just be a bad year in terms of sales. So really important consideration. I don't think this is talked about enough, but there's a couple of things here. So you showed, prior example, putting money into a 401k and profit sharing. That's easy for the owner to turn that off and let off some of the pressure, right? And then by having this 2-tiered formula, in terms of the funding of the plan, that gives a lot of freedom to allow a base of income to come through without requiring much of a contribution. And then if it's a big year, it funds. So I think you've told me about another mechanism also with the 1,000 hours. And
yes. So under the safety net theme, right? If you have this flexible formula, you can always take less pay for the year, and that would result in a lower contribution. But let's say it's even worse than that. Let's say that it really turns south and the outlook just does not look rosy at all. If you do so before any employee works 1,000 hours in a year, you're allowed to freeze the plan. So,
Mhm.
so that actually happened with COVID. We had a lot of clients kind of freeze the plan just to see what was going to happen. So
Mhm.
in early 2020, froze their benefit. What happens then is that nobody is accruing a new benefit for the year. So by that, you're able to keep the plan going, but there's not a new benefit being accrued for the year. So again, catch it before 1,000, freeze the plan. Even more drastic than that, there were plans that we set up in 2008 for real estate firms. Right? Remember what happened in 2008 in the real estate world. It was
Wasn't the
not
best
great.
year. Yeah.
Right. So there was even a plan that I said 3 to 5 years is what the IRS says these plans must be around. But we had a plan go for a year, had to terminate. The business just wasn't valid, wasn't solvent anymore. And so submitted to the IRS for a determination letter on terminating the plan after just a year, and received an affirmative letter that yes, this can happen. So if there are circumstances that allow for it, certainly the
Yeah.
drastic solution would be to terminate the plan. You don't want to, but
Right. So there's a few safety net or safety valves to work with.
yes,
That's great. That's good to know. Definitely points to the value of having good consultants. You can pick up the phone and say, "Hey, this is what I'm seeing on the horizon, or this is where I'm at. What
yep,
can we do?" What about? And I don't want to get too off track here, but I think this kind of relates. Investment performance in the plan. So that's kind of something we take a look at. I think there's a few issues there, right? In terms of, normally people want all the upside they can get, but there's some issues in terms of the plan there, or just bad investment performance, potentially requiring more contributions, and that gets into maybe some of the funding mechanisms or the way
yeah.
that's credited.
Yeah, great question. I'm gonna share that dentist example again, just because it'll be easier to be pointing to some people when we look at that. But we all know that in the 401k world, uh, there are individual accounts. Each of the hygienists, each of the assistants, each of the office staff is controlling his or her balance in that 401k profit sharing plan.
Mhm.
Whereas in the cash balance plan, it is a pension plan. These contributions, is $800 contribution to the pair of assistants and the $500 per year going to the pair of office staff. Those go into a pool of assets, and
Mhm.
they are invested under the direction of the trustee, in this case, the dentist. Um, from the assistant's point of view, this plan might have we call it an interest crediting rate of 4%. So from that employee's perspective, that $400 contribution is guaranteed to grow annually at 4%, guaranteed
Mhm.
by the dentist.
Mhm.
So what does that mean for the investing? Well, it means that if you want your contributions over time to remain consistent into the plan, you would want investments that return 4%,
Right.
because that's what the plan is promising. Well, you're never going to hit exactly 4%, or well,
Mhm.
seldom will, if the investments lose money for the year. Well, then you've got an underfunded plan,
Mhm.
which will have to be made whole over the next 14 years.
Mhm.
So you just increase the contributions over time. If, on the other hand, the investments go through the roof, do great for the year,
Right.
then your future contributions are going to go down because the
Yeah.
investments have done the work of funding the plan for you.
Mhm.
So it's interesting that in the cash balance plan, that is a pool of assets, and it's directed by the trustee, the dentist. Now, when the dentist is getting 240 out of $241,300, that becomes less of a concern. When
Mhm.
you're Caterpillar, and most of the assets are owed to the employees, that's a bigger concern. When
Yeah.
it's all the kind of the dentist's money, you feel like you can be a little more aggressive if the dentist wants to be, because again, if you end up making $100,000 on the assets in a given year, that's, well, sure, you don't get to put 100,000 in the next year in tax advantage contributions, but you found $100,000, so you're not too upset about
Right,
it.
right. It's there on your balance sheet in another form. Courtesy of the market returns. But it is something that we spend time thinking about, because often we'll be working with folks and they'll have, an array of different types of accounts that they have investments in that we're working with. Instead of saying, here's the recipe that we're plugging equally into each account, we very likely look at that and we think about tax location, the tax treatment of the different types of accounts and the different investments. So we like to look at the overall household and say, okay, Roth IRA, this is a tax-free account. Usually it's a smaller dollar amount in the overall allocation. Let's put our highest opportunity set holding there, something like small company stocks that they might be very volatile, they might be unpredictable, but over 20, 30 years, we expect them to have really strong returns, really benefit that tax-free nature. And in like a taxable brokerage account, we'll be thoughtful about the types of holdings there, so they're not generating interest or dividends or capital gains that are showing up on tax return each year. And then something like this, the extra element of, okay, it's a tax sheltered plan, that's an important consideration, but we're really thinking about that liability driven investing and an investing target. We're aiming for a more consistency of returns in this type of portfolio.
Yep.
Yep.
I find that this is another added benefit to the employees, because even though in this example that we have on the screen, the employees are only getting a 1% contribution annually in the cash balance plan, more commonly it might end up being 3%, let's say. And the fact that now is guaranteed to grow at X%, something like 4%, guaranteed by the owner. That I think, Scott, allows you to help that employee by saying you've got your fixed portion of your,
Yes,
right, that it's guaranteed by your employer, and it's a great benefit. It's not going anywhere.
Right.
Cool.
Yeah. Maybe we should just touch on this, because it is a cash balance defined benefit pension plan. We've talked about pension plan, we've talked about traditional pension plans, but in real life with these types of plans, especially for the solo practitioner, the small, the mid-sized business, that dentist that we keep talking about, I mean, what are you seeing them doing most often at retirement with that plan?
So the great thing with these is that the owner, the employees, once this plan has run its course, so to speak, because you will get, if you run a plan for 8 to 10 years, a business owner might get to the point where they've accumulated enough money that they can fully fund as much as they'll be able to get out in retirement. So then what? Well, terminate the cash balance plan. And now, just like you would do when you distribute assets from a 401k plan, the employee can roll it to an IRA. They could, heaven forbid, cash out and spend it. But oftentimes they just roll that into the 401k plan that keeps going.
Yeah, right.
Or an IRA. But yeah,
Right.
that's typically.
So it's not that you're necessarily, if you're 45 or you're 50 or you're 55, you're instilling one of these plans, you're not necessarily handcuffing yourself, for better or for worse, into a monthly pension payment for the rest of your life in retirement. You could choose to do that. And we like talking about that. Sometimes there's a real advantage to having a stable floor of income in retirement. In years like this, a lot of people that have that type of stable pension plan really appreciate it.
Right.
But a lot of people
rare.
Don't like that. They'd prefer to know that, okay, we're using this pension formula to build up a balance, but then at retirement, we'll roll it into the 401k plan, into the IRA plan, and take it out as we see fit at that point, invest it as makes sense according to our goals. Maybe we really need every one of those dollars to work for us, and annuitizing it or creating a pension stream is very important. maybe it's excess funds at that point, and you look and say, well, this is more probably legacy money. Should we consider Roth conversions with some of this? Is some of this going to fund our charitable or philanthropic goals? Is this legacy money for our kids where we can keep it invested, foot on the gas, because it'll transfer to them 30 years down the road. So there is quite a bit of flexibility on the tail end. It's not that you're committed to a pension stream where you get that, and if you live a long time, it's a great thing, and if you pass away early, it's gone.
Yep. Something you just said brought to mind another way that these vehicles are used. You said the kids. So let's say you've got a business owner that is going to be transitioning the business to their children, or maybe it's just to another owner. And you've got a minority owner that's buying out an older majority owner.
Yeah.
So you put a plan like this in place where the majority owner, older, is getting a giant contribution, one of these big ones like the dentist is getting. But the minority owner is younger and not able to get as big a number. So let's say that they are now 50-50 owners. Majority owners getting $200,000 more than the minority owner, and they're continuing a buyout. Well, that could be construed as a $100,000 buyout payment, from the minority to the majority owner that's being done on a tax advantage basis. So
it's kind of trued up on the business sale or transition price or the earnout calculation. Yep.
Just an outside the box way to think about using a cash balance plan. Just thought I'd throw it out there.
I don't know if you have it at hand. I know you've showed me before, because you showed us some examples of like the 1 year contribution for the dentist. I mean, what is the target? Because I mean, you can effectively max out these plans, right?
Right.
Someone on kind of a short timeline, and they're putting that big contribution in for 10 years. Like I say, I don't know if you have anything at hand that you can show us that kind of.
I do. So matter of fact, this was a fairly recent scenario, and I've taken names off, obviously, but this was a relatively recent one where this happened to have been an attorney again, and a good year, older attorney, older than I, at least 71, but you're going to see a cash balance allocation for this first year of $426,000 and change. And the actuary here is using another lever, calling it opening balance, but down in the corner, you're going to see, I'll highlight this in yellow, a maximum contribution for this first year of $676,000 in the cash balance plan. That's the biggest one I've seen, so I thought it'd be a good one to share. And this is the first year being its opening balance. Is what we're doing is allowing this attorney to overfund his or her plan this first year. The second and third years are going to be funded very minimally, still funded, still enough to be a meaningful benefit and satisfy the rules, but it's going to be so front end loaded that those second and third years don't need very much, but this happened to have been a good year for him or her. So
wow, that is impressive.
You don't see these numbers horribly often, because you don't always see this set of circumstances where it's a 71-year-old and soon going to be retiring. It does work like this sometimes, obviously. So
I mean, in this situation, it almost functions like a deferred compensation plan that we sometimes will see or work through with executives at companies, where you can say, okay, big earning year, big final earning year, let's defer that into this deferred compensation plan and spread that benefit out over a number of years on the back end, instead of having it come in a big taxable tsunami in that last year. So
this was an interesting one.
I think we've covered quite a bit from a high level in terms of these plans. I appreciate your time. One thought came to mind as you're talking about the 401k plans and reviewing this. Something that I think we've seen, I know you and I have talked about, is it's pretty common. entrepreneurs, business owners, they are busy and they're wearing a lot of hats and dealing with a lot of things. And it would be tough to expect them to be, perfectly up to date all the time on things like retirement plans. But sometimes when we're looking at this and this idea of enhanced retirement savings or tax savings comes up, we start looking at it and look at their 401k plan that maybe they have in place. Or you mentioned simple plans converting to 401k plans, but a lot of these plans are, they're due for a review. And, across the board in the financial services industry, one of the wonderful things that's happened is a lot of costs have come down and there's been a lot of enhancements in terms of the bells and whistles, the access, the information, the investments inside. And I feel like fairly commonly we'll see a small business owner and look at their 401k plan. It's something they put in place 10 years ago, 15 years ago, and it hasn't really been reviewed since in terms of the cost, the chassis, the investment selection, and a lot of those things have improved. Any thoughts to share on that?
Yeah. In addition to all of those things, and you touched on it, but plan design.
Oh yeah, right.
With in mind both the employee and the employer. Is it now time? Have we gotten to the point where the business owner can get more for him or herself using this cross-tested scenario? Is it time that you need to start making it more generous to the employees to attract more people? Again, in your example, if it's been 10 years, there might just be a good reason to have a conversation just by way of educating the business owner as to what new has happened in 10 years that you should be made aware of. Maybe it's the concept of automatic enrollment, which is really gaining popularity as well, which would be kind of setting the default participation rate for your employees to be something other than zero, right? So you're encouraging them to participate in the plan. That in 2006, and it was 2006 when that legislation came on. It's been that long, but very low uptake on the idea of automatic enrollment. Lately, it's really getting popular. So that's just one example, though, of the things that might be of interest in the 10 years that it's been since you last looked at it.
Very good. Well, we have a couple minutes left. If anyone has a question, feel free to pop it in. Otherwise, maybe as some concluding statements. Every business owner, I think, should take a look at their 401k plan. If it's been a while, get a review, get an analysis, look at the costs, look at the features, look at the plan design, as Jason says. That's a great step, whether you're thinking about putting more money into the plan or not, just making sure that plan is working for you and your employees. It's part of your benefits package. It's part of your recruiting, your ability to attract and retain talent. So very important there. If you're looking to accelerate your accumulation, save on taxes, that profit sharing formula, great opportunity there in plans, and looking at some of the design and the profit sharing formula. And if you're in that happy situation where things are really going well and you're really looking to save on taxes and supercharge your savings and build up a rapid accumulation, this cash balance pension plan concept is just such a powerful one. So feel free to reach out with any specific questions. Like I say, if you're listening to the audio, the video might be helpful. Jason has some really nice illustrations and slides, and I'm sure Jason would be happy direct reach out to him as well at Tax Shelter Consultants. But really appreciate the time. Thanks, and may try and beg you back on for another one. Maybe we could talk more about just profit sharing plans or another exciting topic. So.
Happy to do it. It takes a special type of person to like talking about retirement plan rules, and a recovering engineer is just happens.
Yeah, you're my guy there. You're my guy. All right.
Thank you.
Well, hey, thanks, man. Really appreciate it. Take care.
Take care.